This is the debate that never gets settled honestly. Real estate investors will tell you leverage is the superpower that makes property unbeatable. Stock market investors will point to the S&P 500's long-term average return and call it a day. Both sides cherry-pick numbers. Both sides ignore costs that change the math dramatically. Today we are doing this properly. $100,000. 2 paths. 20 years. And every cost accounted for. Let me be clear about what this is not. It is not a declaration that one is always better. It is the actual math, laid out so you can make a real decision for your situation, not based on whoever made the most confident YouTube video. Let's start with stocks because the math is simpler. The S&P 500 has delivered an average annualized total return, including dividends, of approximately 10.5% per year over the last 50 years. The Vanguard S&P 500 ETF, though, charges an expense ratio of 0.03%. Effectively zero. You take $100,000. You put it in VOO or a comparable index fund. You leave it alone. At 10.5% annualized, after 20 years, your $100,000 becomes approximately $728,000. That is without adding a single additional dollar. Pure compounding on the original investment, net of that 0.03% fee. Tax treatment: if this is in a taxable brokerage account, you pay long-term capital gains tax when you sell, 15% for most people, 20% for high earners. If it is in a Roth IRA, the entire $728,000 is yours, tax-free. We will use the taxable account for this comparison since we are comparing to real estate, which also has tax implications. After paying 15% capital gains tax on the $628,000 gain, you net approximately $634,000 in after-tax value. Call it $635,000. Transaction costs to enter, 0. Transaction costs to exit, 0. Ongoing management time, 0. Liquidity: you can sell any portion in seconds during market hours. That is the stock market case. Now let's look at real estate, with the full picture. Real estate's headline advantage is leverage. And to be fair, it is a real advantage when it works. Here is the standard scenario. You take that same $100,000 and use it as a 20% down payment on a $500,000 rental property. You now control a $500,000 asset with $100,000 of your own money. The other $400,000 is a mortgage. National average real estate appreciation has been approximately 4.4% per year over the long term, according to the Federal Housing Finance Agency House Price Index. In some markets, significantly higher. In some, significantly lower. On a $500,000 property appreciating at 4.4% per year, the property is worth roughly $1.19 million after 20 years. Your mortgage balance after 20 years on a 30-year fixed at 7% is approximately $295,000. Equity, roughly $895,000. But you also put in $100,000. So your actual gain on that original investment is $795,000. That sounds dramatically better than the $535,000 gain from stocks. And the real estate crowd will stop the analysis right there. They should not stop there. Here is every cost the leverage argument conveniently omits. Mortgage interest. On a $400,000 mortgage at 7% over 20 years, you pay approximately $380,000 in interest. Not principal, interest alone. That is cash out of your pocket. Maintenance and repairs. The standard rule of thumb is 1% of property value per year for maintenance. On a $500,000 property, that is $5,000 per year. Over 20 years, that is $100,000, though this figure rises as the property ages. Many landlords report 1.5% to 2% annually on older properties. Let us use a conservative 1%. Property taxes. Average effective property tax rate in the US is approximately 1.1% of assessed value per year. On a $500,000 property, that is $5,500 per year at purchase, rising as the property appreciates. Over 20 years, this totals roughly $130,000 in property taxes. Vacancy. The average rental property sits vacant 5 to 8% of the time, roughly 1 month per year. On a property generating $2,500 per month in rent, that is $2,500 per year in lost income. Over 20 years, $50,000. Property management. If you hire a property manager, which you will need unless you enjoy 2 a.m. maintenance calls, expect 8 to 10% of gross rent. On $2,500 per month, that is $250 per month, or $60,000 over 20 years. Landlord insurance. Approximately $1,500 per year above and beyond homeowners insurance. 20 years, $30,000. Transaction costs. Real estate agent commissions on a sale run 5 to 6% of sale price. On a $1.19 million property, $60,000 to $71,000 gone immediately upon sale. Capital gains tax on the property sale. Depreciation recapture is taxed at 25%. Long-term capital gains on the appreciation are taxed at 15% to 20%. This is complicated but realistic. Plan for 18 to 22% effective tax on the gain, depending on how well you structured the deal. Let me put all of this together. Real estate, $100,000 down payment on $500,000 property, 20 years. Property sale price at year 20, $1,190,000. Mortgage payoff, $295,000. Gross equity at sale, $895,000. Now subtract total costs. Mortgage interest paid over 20 years, $380,000. Maintenance at 1% per year, $100,000. Property taxes, $130,000. Vacancy losses, $50,000. Property management, $60,000. Landlord insurance, $30,000. Transaction costs, 6% $71,000. That is $821,000 in total costs and payments over the holding period. But you also collected rent. At $2,500 per month, that is $600,000 in gross rental income over 20 years, reduced by vacancy to approximately $550,000. Net position, $895,000 equity minus $821,000 costs plus $550,000 rental income. Before taxes on the sale, $624,000. After applying an estimated 20% tax rate on the gain, approximately $505,000 in net after-tax value from your original $100,000 investment. The stock market, same $100,000, same 20 years, after capital gains tax, approximately $635,000. In this scenario, with national average numbers, stocks win by about $130,000 net. And stocks required 0 hours of your time, 0 midnight calls, and 0 contractor negotiations. Real estate does win in specific conditions. High appreciation markets. Properties in markets that appreciated 7 to 8% annually, Austin between 2010 and 2022, parts of Florida, Denver, the leverage amplification makes the numbers dramatically better than national averages. The math flips significantly in real estate's favor when appreciation consistently exceeds 6%. Forced appreciation. If you buy a distressed property below market, renovate it, and force appreciation through improvements, you create equity the market does not give you for free. This is the BRRRR strategy: buy, rehab, rent, refinance, repeat. It works when executed properly. Most people do not execute it properly. House hacking. If you live in one unit of a duplex or triplex, your personal housing expense drops towards zero while tenants pay your mortgage. This is one of the most powerful wealth building moves available to someone in their 20s with modest capital. tax advantages. Depreciation allows you to deduct a portion of the property's value each year as a paper loss, even when the property is gaining value. This can reduce your taxable income substantially if you qualify as a real estate professional under IRS rules. And the real estate case improves dramatically if you refinance strategically, use a 1031 exchange to defer capital gains, or operate in a low property tax state. Here is what the math actually says when you stop picking sides. A nationally diversified index fund, held for 20 years without touching it, beats average real estate returns in most scenarios on a net, after-tax, after-cost basis and requires zero work. But real estate, in the right market, with the right structure, and with competent execution, can produce significantly higher returns because leverage amplifies appreciation in a way that stocks do not. The honest answer is this: most people who say they invest in real estate are not buying in high appreciation markets, not executing forced appreciation strategies, and not managing their properties efficiently. They are buying average properties in average markets and discovering 3 years in that being a landlord is a second job with unpredictable pay. The best approach for most people is not a binary choice. Index funds are the baseline: accessible, liquid, low-cost, time-efficient. Real estate is an upgrade layer you add when you have the capital, the expertise, and the time to execute it properly in the right market. If you do not have all three of those things, capital, expertise, and time, you are better served by maximizing your index fund contributions first. The math does not lie. But it does require you to count all of it. Word count: 1/320 duration, 10-minute end card. Next video: the car payment trap is keeping you poor.